Hello, and welcome to the latest episode of the Friends of Sanctuary podcast. I'm Marianne Bartels, Chief Investment Strategist at Sanctuary Wealth. Today, I'm pleased to welcome our guest, Cliff Corso, President and Chief Investment Officer of Advisors Asset Management, or AAM. Welcome, Cliff.
Well, great to be here.
It is so wonderful to have you. Advisors Asset Management, or AAM. I'm going to be really honest. I've been on Wall Street for a really long time. I'm really not familiar with your firm, and I'm very eager to learn about you because you cover many different asset classes. Can you tell me and our listeners and our viewers something about your company that they should know?
Absolutely. And you're not the first. It's interesting because we are a 40-year-old company. And I think the name kind of captures the essence of what it is that we do. Advisors Asset Management. That's been the name of the firm for that whole length of time. What we try to do is act as the advisor to the financial advisor. We're trying to be consultative with them, trying to understand what type of investment strategies they're trying to put together, and ultimately trying to help them produce the outcomes they're trying to produce for their clients. And we do that in several ways. One key way we do that is that we have investment products that we have curated with outside non-affiliate managers across all different asset classes. So think equities, fixed income, alternatives, our newest evolution. And then within those asset classes, there's multiple sub-strategies of different types. And then as well, we offer those in the way that financial advisors might want to consume them. So that could be an SMA, that could be a UIT, it could be a mutual fund, it could be an ETF. And now it can also be evergreen type structures and alternatives. And we're trying to be a very flexible partner to the FA, who has a lot of challenges in trying to put together the solutions they're trying to put together.
So I would be curious, the advisors that you're advising, are they in the wirehouse? Are they independent? Do you see a tilt one way or the other?
Yeah, we're pretty well diversified across the channels. I would tell you the way we grew up historically started as a very simple fixed income shop, sort of the outsourced bond desk, and now evolved to the platform that you just heard. Through that history, we've expanded the channel penetration. So I would tell you today about 50% of our flows, let's call it, come from the wires. And then it's heavily diversified, equally diversified across RIAs, independent broker-dealers, and banks. So we've got a pretty diverse business mix focused on the wealth channel.
Can you dive a little bit more in on how you partner with advisors? Can you give us a little bit more detail for anyone that's out there listening that would be interested in partnering with you maybe?
Absolutely. So we have about 150 people who are regionally decked across the United States. And so we're trying to meet the advisor where they live. And each of those advisors at AAM are trying to develop a relationship, a consultative relationship with the FA, because we have a lot of products, but we're not a place where it's just, here's my product, you want to buy it, here's my product. It's really trying to understand what they're trying to accomplish within their portfolio. And it could be, it starts typically with conversations. What are you thinking about? What are you worried about in the market? They'll often be looking for our views. I'm the CIO. We have a CIO office. And again, we're trying to help them solve the things that they're trying to solve for their clients. So an example might be the other day, somebody was asking about fixed income. I've got fixed income of such and such a maturity profile, and I'm hearing a lot about private credit. Tell me a little bit more about that. And so we go through a conversation educating on that. And then how would that fit in a portfolio? What am I taking that out of? What does the design of that portfolio look like? Is the manager good? We've vetted the managers. And very importantly, what we're proud of on our model is the FA at Sanctuary has exceptional access to the portfolio managers who are actually pulling the triggers on the portfolio. We're really specific about that because I think people want to touch the people who are actually in there in the trenches managing the assets. We also have education. We hold conferences and due diligence meetings throughout the country. CE credits. We have white papers. We developed something called AAM University. I know a lot of people have education out there. I think it's table stakes because I think the world is evolving in a more complex way where education is going to be a value add.
So what it sounds like to me is you're almost like an independent consultant. You don't have a bias with your products, but you understand your products. You have a firm view, and then you meet and listen to an advisor and really try to help them to accomplish their clients' goals in their portfolios, is really what I'm hearing from you.
I think that's exactly right. And we like to think of all these solutions and the formats they can come in as mere building blocks. So we've got blocks on the table, and we're trying to help create a portfolio that's optimized. How do these blocks fit or not within a portfolio construction?
So you've been on Wall Street for quite a while, like myself. I might be a little bit more than you. So you're a little over 35 years. You've done a lot. You've touched a lot of money, at least like $500 billion. What are some of the things that you've learned as you've progressed your career on Wall Street? Or what piece of advice can you give people that are out there?
So many lessons. Could be the whole 30 minutes. But I would say, and these aren't earth-shattering, but I think they're just fundamental, powerful tenets of investing. And one that really struck me was in 1987. I was working for a bank, and some of the viewers who are around there will remember this Black Monday stock market crash. I remember it well. I was
So do I.
pretty young, and I saw everyone hovering around the screens, and there was lots of screaming, and most of it was sell, sell. And the thing plummeted down to 20% down, and a lot of folks checked out of the market on the way down and locked in their losses. And I think one of the big lessons there was not to be too emotional and react and not try to time the markets. And I think that was onboarded by just watching that experience, because if one had held, it wasn't the most robust year in 1987.
But you didn't close down.
You didn't close down. You actually made a little bit of money. If you take it and extend it, the other thing I think a lot about is what's your time horizon when you invest. I'll give you maybe an extreme one. If you had invested $1 in January 1987 in the S&P and held it all the way through 2024, you would have had a 5,600% return, or better said, 11.2% annualized return. Not bad.
That's not bad at all. And I've always told advisors and their clients, at least during my career, there's always a year not to buy the markets, or there's always something happening that is worrisome, so you want to sell something and have cash. And generally, that's the wrong answer. Because, at least in my experience, what I found, if the client did sell and sold correctly, that's one decision maybe they got right. Now you have to get the other decision right. You have to buy at the low. And the problem I see clients with is the low is when the news is the worst, so they don't buy.
Yeah.
And that's why you're just better off doing the long-term hold.
I think when I think about mathematics that we try to apply to investing, and bell curves and statistics and all that stuff, I always think I did a lot of work studying statistics in physical sciences and things that are predictable. When we're trying to map the statistics of markets, really mapping very much human emotion. That's inherently unstable, I would argue, and it's prone to tails. And so that
fear and greed.
Fear and greed tails, exactly right. And what I've discovered is if you can keep, and it's hard to do, as you well know, because if you're trying to pull back when you think things are getting riskier and riskier and take some of that risk off the table, it could go on for a long time. And it's like, cocktail party, you said that last year and I beat you by such and such. So the pressure on short-termism in our markets is very heavy. But if you can take that step back, not that easy to do, inevitably, I believe there are cycles in markets and life. If you have saved some of that powder, when the market goes kaplooey down the wrong way, the fear tail risk. The fear tail risk is a very fat opportunity because the prices get much more disconnected due to the fear than arguably when it's in a greed market. And yeah, they're tight, but so you want to be able to keep your wits about you. Could be for years, but have some component, because boy, you can really kill it.
But I think that's also where rebalancing comes in for clients. Would you agree with that?
100%, yeah.
So always look to work with your advisor to rebalance that portfolio. In today's landscape or financial investment landscape, I think you really are a differentiated company. I have not come across, to be real honest, I've never come across a company like yourselves. And I'm in the business for 40 years, but I've never been an advisor. I've been on the institutional side, and I was in the CIO office of Merrill. Um, how do you differentiate within the industry, and how do you stand out? And do you even have competitors in the industry?
It's a question we get asked often. Who is your biggest competitor? And, some companies will say, well, no one's really a competitor, but they are competitors. We are pretty unique, as you point out. There aren't very many firms like AAM. So we're independent. So that means about 300 people at AAM. It's one of the larger independent distribution partner firms in the United States. The other differentiation is we're not beholden to a parent company that says, this is the stuff you're going to sell, whether you like it or not. We're open source code, and we are truly trying to find two things. Where's the value in a solution that the market will find valuable? And then when we find that, who do we want to partner with? Who's going to bring the best of the best within that? And so I think that's unique. We do have affiliates. We were purchased 51% by Sun Life a couple of years back. Sun Life has very strong alternative capabilities within the family. But it's not and we will work with them because they're exceptional, but we can go away in all other areas that make sense. So I think that's been unique. Our experience in curating a best-in-class institutional asset managers has been exceptionally strong. And so we've earned a lot of trust by intermediaries and FAs to say, okay, if AAM's putting a product up and putting their name on it, it's probably a pretty good product. It's probably going to do what it's supposed to do within the portfolio. So they're long-term partnerships. They're not a placement agent thing, long-term partnerships with the clients.
So I'd love to find out what you think about markets and the economy. So it's still relatively early in the year. We're still in the month of February. Um, we have a new president um, that has signed a lot of executive orders. I think you hear the name tariff every single day. Whether he's doing something with tariffs, the news are talking about tariffs or potential tariffs. We recently had inflation data that came in hotter. They like to use the word hot. Both CPI and PPI came in a little hotter. So for an investor that is nervous because the news doesn't necessarily sound that great, the markets they went up, they went down, they've been a little choppy. What kind of is the outlook that you're seeing for 2025, both on the markets and on the economy?
Sure. I think we would, there are a lot of cross currents, as you're pointing out. Trump 2.0 is a big pendulum swing from the previous administration. And it's even a stronger pendulum swing than Trump 1.0. A lot of the same playbook, but kind of 2x. And 10% tariffs going to 25%.
Feels a little bit more than 2x.
Yeah, it does feel more than 2x. And the speed of it is like 3 or 4x. But I think when we take a step back, we have this phrase where we're framing it out for 2025, is we are cautiously optimistic at how the year will work out. And I'll talk about quickly about the optimism, and I'll talk about the cautious part of it. We're optimistic because the economy's coming in with a good head of steam. And we could talk more about the consumer, but unemployment rate's exceptionally low. It's 4.1. The consumer is actually beginning to gain a little ground, wages versus inflation. Wages are running at 4 and inflation is at 3, let's argue. A little bit of ground there. The credit spigots are open. That's a good thing in the short term. Maybe not such a good thing in the long term if it goes too long. And people have jobs. So I think consumer puts us in a pretty good position as we begin this year. The tax extensions and cuts would be a fiscal, gas pedal still, propelling certain sectors of the economy. Deregulation would be a positive in our minds, certainly for certain industries. So that's the optimistic side of it. The cautious side of it is the things we talk about every day. Tariffs, what are they going to do? Are they inflationary? Are they not inflationary? Immigration, that's going to reduce the supply of labor. Labor, how tight is labor? What is that going to do to wages? So you have, and then you have just this theme of America first, and really the bigger theme of deglobalization that's occurring, and countries are forming their partnerships. And so instead of operating in a world that we enjoyed since the wall came down with Reagan, we've been operating recently in a reversal of that. I think the risk is inflation. These are, we would argue, inflationary policies. You mentioned the inflation number. We've been paying careful attention. Our view is it's going to be sticky. This 3% number makes sense to us because job market's okay. The housing market's unique and interesting in that supply is still light because people are not selling their homes. It's 1/3 of CPI. Wages are 4%, coming down, but that's still above the 2% target. And that's a massive chunk of CPI. So what does the Fed do? And what is this market going to do? We think 3% could be the new 2%. That's okay, actually.
It's not necessarily bad.
That's okay. I agree. Because we are, my 35-year career, inflation's been around 3%. I mean, it went up, it came down, but it's been about 3%. Markets have done fine, actually. The two things to note is, I think about that is that as long as it's stable, so we're not guessing every day about where it might or might not go. And I think the other key thing about it is that rates normalize around that. And I think we talked about emotion earlier. I operated, heavy duty fixed income through the global financial crisis with a firm that was in the center of the crisis. And that was a fun experience. What we got out of it, the zero rate environment that was engineered by the Fed, negative rates. I never read that in my textbook, by the way.
Neither did I.
Manipulated markets for decades. And so a little bit of a trap, with the 2%, trying to get it above, get it to 2% inflation. So the world has changed. We are normalizing interest rates. And I think we are there almost, meaning a Fed funds rate at 4.25 with a 3% inflation rate is a real Fed funds rate of 1.25. That's not tight by any stretch of history. So you've got let's call it neutral Fed funds rate with maybe a growing economy and some of these other things that might aggravate inflation. So you could see, and it's not shocking, I'm not trying to shock anybody, but the 10-year Treasury, back through the long sweep of history that I know, it was a little sloppy, but it was pretty darn good measure. You could say, the 10-year Treasury historically trades around nominal GDP. It's pretty good rule of thumb. Now we can pick our numbers. We think it's a 2.5% GDP year coming. We think inflation is going to be 3%. So we could see a 4.5% 10-year.
Which is where we are, at least at the time of this recording.
Exactly where we are. If inflation is a little bit hotter and the GDP runs a little bit hotter, could you see it push to 5? Maybe. But there's no way in our minds that cracks through 3% into 3% unless there's a real slowdown because it's normal.
Basically, we've gotten back to normal, but it's investors that have to start feeling normal. So you have a strong fixed income market.
Yeah.
One of the questions when I'm out with clients that if I don't talk about it, they'll definitely ask me about it. Everybody's concerned over the deficit and the interest payments. And we have a new Treasury Secretary that looks like potentially will try funding the deficit at the longer end of the yield curve. You've heard comments that our interest payments are more than what we're spending on defense. When it lands on the deficit, what do you say to your clients?
It's a growing problem that the market is whistling past the graveyard on for the moment. We've seen an instance in the UK where there was a flare-up around the deficit. You may remember months back, Liz Truss came in and changed the projection for the deficit to make it higher. And she lasted in office like 4
Days.
weeks. Yeah, like
Days or hours,
out.
kind of.
Because the vigilantes,
The
that
bond
you and I know
vigilant-
real well, came out. And so this is not going to be good.
And that hurt the pension funds, and
Created
it was
a whole
a chain reaction.
Chain reaction, which pension funds who rely on leverage, and they were getting leverage called, and it created a whole flywheel. And maybe it's a harbinger, ghost of Christmas future. I think the key in what
2025.
I don't think in 2025. I think Scott Bessent,
Our Treasury Secretary.
yes, he classmate of mine, same year. He is interesting in that he really understands the bond market and all the machinations of what goes on inside this bond market. I think he's right to point to the 10-year and longer end of the market because that's where so much financing goes on. Your car loan, your house loan, a massive amount of financing occurs there. So it'll be an artful dance to try to figure out how to refund and get away from 30% of our debt is coming due in the next 3 years. That's risky. How do we feather that out the curve, get a longer duration, more stable rate curve? And then I think the goal would be...
So you have consistent payments.
I think so.
And you don't worry about that rolling over interest rate.
Mary, I think it's kind of like the opposite of when you want to buy a bond letter. It's you wouldn't want to necessarily have big gobs coming due over here or over there. The front end can move around a lot because of Fed control and inflation. The long end can move for unanchoring of inflation expectations and all kinds of things. To just try to create a market-like consistency and predictability, try to create a consistent story of how this debt issuance pattern is going to go and how that's going to interplay with deficit reduction, right? So less supply, ideally. And he's got this...
We've got Doge.
We got Doge.
That's another daily headline that we have.
We got Doge. And they're trying to cut $1 trillion, I think is the current number. I also think the key metric on this whole thing is, because debt to GDP is about 100%, is the interest rate at that level cannot exceed the GDP. Because if it does, then you got to raise taxes. So that's your ground zero. And we're right there. So I worry a little bit about, the fly off the handle. We need to lower rates. I think if Powell went dovish right now, the long end is going to go higher.
Because they'd start pricing in inflation.
What are you doing? So I think I could see a scenario where they stay pat all year. And
which is not bad. They already cut 100 basis points.
I think it's fine, to be honest with you.
So I kind of feel like we're in a Goldilocks environment. We've
totally
got
fine.
everything working and we're not smiling. And we should be smiling. And we didn't even talk about innovation. So I'm very big on innovation, right?
Yeah.
Artificial intelligence, robotics.
Yeah.
We've got blockchain. You've got crypto, virtual reality with Meta. There's so much going on and so much CapEx spend that I think sometimes we're losing sight on the power that can potentially have on productivity enhancement and how that can positively impact earnings.
I think you are spot on that part of the equation, because the economic speed limit is typically defined as population growth within employment and productivity. And population growth pre-immigration was usually 0.5% to 0.75, and then your productivity was 1.5, so your economic speed limit was 2.25. That's kind of the way we were growing. Now you have this AI. I don't know exactly what number to put in there, and I know it should be higher. And we had immigration, up until a couple of months ago. That's more jobs. That should have raised the economic speed limit, taking pressure off inflation. So we'll have to see how all that plays out for sure. But I think that's another key to the evolution of where we wind up here,
right?
In terms of debt to GDP, and that's a key part of it for sure.
So I want to switch gears a little bit. Let's go into alternatives, because that's really been a very big growth part of the market for the wealth management industry. It's really, only the past few years where they've been able to create products
Mm-hmm.
that have a little bit more liquidity
Yes.
than in the past. And we're starting to see financial advisors adopt these private instruments within the portfolio, and they've
Mm-hmm.
done very well the past few years.
Mm-hmm.
Can you talk about some of the private side of AAM's product offering?
Sure, happy to do that. So we have partnered with Sun Life, I mentioned earlier, and external alternative partners to create a slate of what we think are interesting alternatives products, specifically structured for the wealth market. And I can quickly talk you through the food groups. It's private credit with a little bit of a different twist to it, which I can explain in a minute. Private real estate, infrastructure, and then you would have private equity would be the big core four. Typically, you would hear in the market of people trying to get access to these pillars. So those are your secular pillars. Why is growing? A couple of reasons. One is there's been a recognition that traditional alternatives have a lot of pain points for individuals. So those so-called drawdown funds where the paperwork is complex and my money can't go in right away and you're going to call it in over 5 years. What do I do with it now? And the financial documents are cumbersome and tax docs are cumbersome. So for retail, those were pain points. But there's been over the last 3 or 4 years, a wholesale change in how alternatives get delivered by product structure. And you may hear things such as non-traded REITs or non-traded BDCs. Those are what is known as evergreen structures. And the punchline on it is that they do offer limited liquidity. So that's an improvement. Simplified tax documents, 1099s, and simplified documents. There's a process now that makes the documents very, very simple. So it's removed a ton of the pain points. There's been a lot of great firms that have come into the market, brand names and Blackstone and Blue Owl and, big firms. But it's still early days because if you talk to intermediaries at large, the asset allocation number into alternatives in wealth is 3-4%. And, sort of the typical ultimate target is 15-20. And the reason that is because adding the right alts in and the right construction can really do positive things to the portfolio. So I would expect this to continue to grow. Venture capital is interesting. Sports as an investment opportunity is interesting. But easy access enhances income, creates diversification, and due to the nature of the private markets, with a good manager, can generate alpha into the portfolio. So your portfolio will be, if you're looking at the gravitation of an asset allocation, I think from your perspective, it would be going up return and going down risk by allocating.
I want to dive into one of the areas that you mentioned, sports.
Mm-hmm.
So it seems like we do everything now sports.
Mm-hmm.
Sports have really, they've always been important, but there seems to be like another level, and particularly with women's sports.
Yeah.
It's about time, by the way, that women get their recognition.
Yeah.
What are the opportunities in the private market for sports?
Yeah, it's one of the fastest growing alternative categories in the world, certainly in the United States. It was heavily regulated, and so it was really hard years back, controlled by leagues, and hard years back to get a stake in investments. That's changed now. The leagues have allowed private equity to come in, and most recently the NFL allows private equity to come in. It's not just the big leagues, which is really cool. And there's a little bit of a debate: are the big leagues so expensive? You own the Chicago Bears, and they're expensive. But there's so many subcomponents, and you mentioned one: women's sports. That's on fire. You look at like Caitlin Clark, and you look at some of the games she's playing, and they blow away some of the stats on eyeballs watching the pro men's sports. So there's a big excitement around emerging leagues, Well, women's leagues and emerging leagues would be things like Sail GP. That's Larry Ellison created Sail League, and now he's franchising it. It's kind of fun. Ryan Reynolds. See how this ecosystem can work. Ryan Reynolds bought the Australian team, I think, but he's already got film crews doing the below deck thing. And this boat bumped my boat, and you get into the personalities, and those shows are, those are money makers. And it's about eyeballs. I think the thing that maybe we lost when we were growing up, we had 4 channels, and we watched everything live. And we go to high school and we say, "What'd you think of Rich Man, Poor Man last night?" And you could talk about it. Now
I can't keep up with all the different programs and all the different streaming channels.
I hear every day. You hear every day. Did you see such and such? No, I'm not going to ask too much stuff. But live sports, people don't want to watch that after. They want to watch it live. And if you think about the emotion around live sports, I mean, my brother and I I hate to say it, New York Giants fans, because our dad was New York Giants fans and his father was New York.
Same here. Grew up in that same household.
There you go. So that's the team, right? And it's just such a powerful emotional category. And then again, as I was saying, there's so many cool opportunities. It's evolving. There's maybe 4 or 5 firms out there doing it slightly different ways. But I look to that to be significant capital appreciation because the eyeballs are growing and growing and growing. And some big players are creating these leagues, like Tiger Woods is creating TGL. That one's on fire already. I mentioned CLGP, professional bull riding, pickleball. All these are explosive sports. So we like that one a lot.
I find that absolutely fascinating because, again, discretionary spend by the consumer. They want live sports, and they'll spend on live sports, and they'll also spend on merch. Yeah.
And the gambling aspect now.
Yes. It was huge.
So there's so much potential revenue opportunity around this. It's tremendous. I think it's going to have a very long wave of opportunity. Early stages, which I think you look at some of the investments that have been made in some of these leagues 6 months ago, 9 months ago, and you look at the media rights getting renegotiated, and they're like 5x from 6 months ago.
Well, advertisers were willing to spend $8 million on an ad for the Super Bowl.
Yeah.
That tells you something.
Yeah. It's going to be a phenomenal evolving place to be for sure.
Well, this has just been an amazing conversation. We've talked about a lot of different things, but is there something that we haven't talked about that you think our listeners and viewers should know about AAM?
Well, we could talk about the price of eggs, but
that's another inflation hiccup.
I'm only kidding. No, I think the big statement about AAM is that we really, really try to work with the advisor as a consultant. We, Charles Sickles, who runs our wholesaling team, who came from BlackRock, he said, we actually have more products in different wrappers than BlackRock. And you don't want to be spraying yourself too wide, but we think we've got really sharp solutions. We're willing to spend the time talking through them, take portfolios back, and big question always is, what do I take this out of? How does it impact it? We'll do that kind of work. But I would say we truly, viewers out there get to know us, you'll truly appreciate the asset management partners who are our partners are exceptional. And we give full access the way we structured it with them.
Yeah, you said you can talk to the actual portfolio manager.
To the portfolio manager.
That's not always common.
Yep, that's a big thing. But we want to win. We want to be the best in the category, and the partners we are partnering with see the great opportunity, and they agree with us. So that's the way we structure.
And you partner locally. You have people all over the country.
All over the country. We represent a sports opportunity fund based out of New York, but a leader who has been very expert across different leagues and buy and sell. They're in New York. We have private credit firm. It's the oldest, most experienced private credit firm, and they're in LA. Exceptional firm. And the real estate firm is the 12th largest in the world in BGO. So we've got a lot of really quality affiliates. And then again, what we love about the model is we don't think we can do everything well. So where we have a gap that we think the market would want, private equity, we will then look for the best private equity firm that we could work with to bring to the market. And we do get a lot of calls because of our distribution platform and the history, but we're very careful about who we're bringing in.
Thank you, Cliff. This has just been a delightful conversation, a very informative conversation, and I certainly learned a lot about your firm and how you're trying to partner to deliver the best for advisors for their clients.
Oh, well, thank you for having me. I very much enjoyed it.
And I want to thank you for tuning in today.
Thank you for watching or listening to the Friends of Sanctuary podcast. Tune in next month to be sure not to miss out on the next installment of the series.